Good morning, Chris. How are you doing, man?
Hey man, I'm good. How are you?
I couldn't be better. This is Brian Jones. I'm here with professional options trader, guru, world's most interesting man, the famous Mr. Chris Hood. I'm just gonna extend your introduction. You're
Oh
gonna be
man.
like Idi Amin, like master,
King of Scotland. There we go.
the last king of Scotland.
There we go. Last King of Scotland. Never been there. Oh, actually, I've been to Scotland. Best seafood I ever had actually was in Scotland.
Oh, really?
Best carrots, absolutely. Lovely place.
I was in England last year. I made it to a few different places like Wales and Cornwall, and I didn't get to go to Scotland, and I have to make a trip up there.
I liked Scotland. I have ancestry from Scotland. So I was trying to do that sort of, hey, your family's from here. What do you think? The only thing I didn't like in Scotland was deep fried Mars bars.
God,
That was the only thing. I had a deep fried Mars bar. I thought I was going to die.
that sounds so American. That sounds like something that you would get at one of these like local county fairs. Like deep fried Twinkies and Mars bars. It's like just immediate diabetes.
Oh yeah, I think one of the precursors is you can't have diabetes when you go and have one. You're certainly going to have it when you come out, that's for sure. Go into hypoglycemic shock. Oh, no thanks. Anyway.
What's going on, Chris? Are we gonna see something? It looks like the market's about to do something, some direction.
It's interesting. I actually think the next couple of days we're going to go up. I'm getting a lot of signals to the upside. The sell-off yesterday afternoon was just horrific. I had a butterfly on, and literally it pinned and then it sold off. But like for about 15 minutes, it was sitting there. And I actually said to my wife, I was like, "Oh my God, this is amazing," And I was in a Facebook group that I'm part of, and I was like, "Hey, this one might just work." And literally, as I clicked send and I posted it, boom, it fell straight down through the toilet. I mean, and I literally had to put there. I said, "This didn't age well at all." I mean, this was just, it was crazy. But we've had a couple of really good pins on some butterflies, which have worked out really well, because I think at the end of the day, you've got to skew the risk reward in the market now. You can't just go in and go, "Well, I'm going to throw a lot of money at this and I'm going to be directionally committed to one side." We've been doing double-sided butterflies. So we've been doing butterflies on both calls and puts, and pinning on one pays off the other, right? So we had that trade on Monday where we had a sort of a double in about 15 minutes. Where we did it. So there are opportunities. I think that the opportunities just need to be thought through. You can't be sitting here going, "Well, I'm going to trade the way that I traded when the market was strongly trending in one direction," right? You can't do that. You have to really refine your plan, and you have to go back and say, "Okay, I'm going to skew the risk reward. I'm going to trade the big picture." All right. So trading the bigger picture is a little easier than picking a stock. We saw Facebook drops 20% on earnings or 25% on earnings. Netflix gets hammered. Amazon up the other way. Google up the other way. You can't get a reading. And that's why I hate earnings trades, because, the day before Netflix announced their earnings, there were a whole lot of people buying call options who got absolutely killed. And then, on the Amazon one, you couldn't have predicted it. 2 earnings reports ago, it had a 4 ATR move to the downside. Now it has a 3 ATR move to the upside. I mean,
People just like to gamble, I think, at earnings.
Yeah, I can't do it. I'm too old for that now.
Legitimately, I've actually listened to a few different trading podcasts that talk about earnings, and they'll pretty much say the same thing. If you back test everything, it's like 50-50. It's like
I don't even think 50-50 comes out. I think you'll probably be at 45-55. It's just not worth it unless you skew the trade. I hate saying definitive things. I'm an economist by trade, right? So remember, I like to talk out of both sides. So the thing is, you can trade them effectively. It doesn't mean you have to be right in order to win, right? You have to remember, in options, you get a lot of flexibility. There's ways to structure trades that stop you from being wrong on a directional move kind of thing. So take, for example, take an Iron Condor, right? So we want the trade to finish inside the range. you're basically making a bet that we're not going to have a move outside of 2 or 3 ATR, right? So you could set an Iron Condor at 4 ATR to the upside and 4 ATR to the downside, and you could get the, you know, the move could be in the middle. The problem is you don't get paid enough, right? So you're taking on this risk and you're not getting a really good return, right? I just don't like inefficient trades. I don't like trading where I have to put down $15,000 of risk to get $100. That doesn't make sense to me at all. So, you know, you can trade it. It's just, it needs to fit your personality. I would much rather take a $15 butterfly with the potential to make $1,000 on a pin, you know, and use some mathematics to get me with the number, as opposed to taking 15 grand and making 100. I just, doesn't appeal to me at all. But there are people who trade it, you know, and, you know, good luck to them. I was writing a letter this morning to my clients where I said to people, you've got to be really careful trying to copy someone else's trade plan, because their temperament, their ability to manage a trade, all of those factors are different from trader to trader. I know traders, some of them that make a ton of money trading butterflies, but I can't trade them as such. I use them as a secondary trade if I've managed to make my numbers on something else using my primary trade. I use them as a prize. I like trading them, but I just can't use them as a primary. And it's the same thing that happens to a lot of people. A lot of traders get sucked into comparisons. They talk to their other buddy and he's been making a killing, you know, buying crypto or whatever it is. And then you suddenly go, oh, I'm going to go do that, you know, and then you scrap your plan, start copying him. He goes into a slump. You are in a slump. You don't know why you're in a slump. It's never a good thing when you start chopping and changing or not understanding why you need to make those changes. If you have a proper plan that says, I'm going to trade these conditions and I'm going to trade these conditions in this way. When those conditions materialize, you know what you're going to do. You're not going to phone your buddy at the gym and say, hey, you know, I've got a buy signal here on Tesla. What should I do? You know, and he goes, well, why don't you do a butterfly trade on ExxonMobil? You know, it makes no sense to me. But yet a lot of people continue to do it. It just seems to be the sort of way that they are. And it takes years and years of discipline in order to train yourself not to follow the herd. You know, just because 23,000 other people are entering a trade on the 813 crossover doesn't mean it works for you. You know, you've got to really understand your temperament and how you trade to take advantage of those things. But there's opportunities. You know, make no mistake, there are people making a ton of money right now. I mean, we've got a trade. I'll pull this up for you. I mean, you know this trade, but for the viewers, you know, here we've got a trade. This is a 50x return on CVX that we've been trading since the beginning of January. That's our current position. But here's our current, these are the trades that we've already closed on CVX from here. You know, and this is in a market that's choppy and down. You know, we've also had Bank of Nova Scotia. Here's another one. I think this one's up nearly 200%. Yeah, 175. Sorry, that sort of goes a bit out of whack. And we're still in the trade. You know, we've already created a risk-free trade, started from here. We've been trading it all the way through here. Our Blackstone trade over here, we're up 322%. I'm not sure if you can see it there. There we go, 322. Whoops. Okay, well, I'll fix that up. This is really weird. Okay, so 322%, and that's since this day. So we've had 1, 2, 3, 4, 5 days, 300%. There are ways to make money. It's just the problem that people have is they try and maintain the same strategy that worked at different times. So, for example, if you took, let's put Tesla on, because this is a bit more, it's not that I'm picking on Tesla. I'm sure that there are opportunities here. It's just, this represents and demonstrates what the point I'm trying to make. A lot of people traded Tesla in this period here. This was when they did the stock splits and, you know, all of that news that was coming out, right? So trading well, blah, 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 single strategy. For the purpose of the point, naked puts, right? So people were trading naked puts. You couldn't have lost. Right? Selling naked puts on a trend like that, there's no ways you would have lost money, all right? It's an inefficient trade because you have a lot of risk. That's off book, but it worked. The problem is a lot of people get in up here and they continue to use the strategy that worked in this period at this point, right? So a lot of people got killed on that candle, boom. A lot of guys got wiped out, all right? That unlimited risk dynamic killed those accounts. So they went down, right? They couldn't, what's that?
So that is a giant red candle.
Oh yeah, and this stock is prone to that. But because it's prone to these kind of moves, it makes this trading strategy here really nice because the volatility gets priced in, right? So now all of a sudden, guys that are selling here because it can do these kind of moves, they're getting paid for it, right? But they're losing here, right? A lot of people gave back all the gains that they made here, they gave it back there, right? So now you've made a ton, you've now lost it all, and you're back to zero, right? So they go, oh, well, I'm going to just carry on doing it because they haven't got a toolbox that gives them a variety of strategies, right? It's always going to be the same thing, right? So now they trade it here. They go, okay, couple days, yeah, this is working. But remember, this is a daily, this is a 4-hour chart, right? So let's switch it to a daily. Becomes a little bit more pronounced, right? So here, bang, they're in. That big red candle is replaced by a green candle. It's just the momentum color. And they lost their money. They're back there. So now they start doing it again in this green volatility band, right? They haven't got the trade strategy right. They just see the momentum shift. They wouldn't have seen this candle, which indicates lower prices to come. They wouldn't have seen this candle, which means higher prices to come. They wouldn't see that for a trade reversal. So from here, they're still selling these naked puts. Now remember, these naked puts, this is a day chart. They need to get theta on their side, right? So they're selling naked puts that have an expiry somewhere, pardon me, somewhere down here, okay? They have these naked puts that are expiring on this calendar date, but they're selling them there. What happens in this period? Kills the trade. So now they've lost again. So they made a ton, lost a ton, made a little bit, gave it all back. Now they minus. Now you minus 20%. All right. Now you get suckered in again. Happens all over again. So remember, now we minus 20. We carry on doing the same thing. Okay. They didn't have these tools. Let's imagine they didn't have these tools, so they can't see this red volatility band starting. They continue to sell these put options. Continue to sell. Continue to sell. And the expiry date somewhere down here. All right. Somewhere here, March, right? Because they need that time value, right? They're not selling 4-day put spread, or sorry, 4-day naked puts. They're selling a month, 2 months, 3 months, or whatever. Bang. Now they've lost it again. So now you've gone from plus 50 to 0 to plus 10, minus 20, back to 0, minus 50.
That's an emotionally exhausting roller coaster to be stuck on right there.
It's horrific. It's horrific. And people get sucked into this because they become, like, I think, no offense to people who are trading Tesla, but Tesla's a bit of a cultist stock, right? It's like the people who buy and trade and hold this or whatever tend to either be very committed users of the car, or they have a idolized view of Musk, right? I mean, that's the way I see it. I trade this, but I trade it intraday. I don't really hold it. I'm not a fan of the cultish thing. I don't look at the fundamentals at all. But this is the normal trading pattern for 99.9% of the world out there. Plus 20%, back to 0, plus 10, minus 50, or minus 20, back to 0, minus 50. Happens to everyone. Happens to everyone. Okay? That happened to me 20 years ago. That's exactly what happened to me. So how do you get out of it? Well, the first thing is you need to make sure that your strategy that you're using is appropriate for the trend of the stock. You can't trade a bullish strategy in a bearish trade. That's rule number one. So here, if we got let's say, for example, we got a green box, a buy calls and sell puts box here. I can't trade a green box in a red band. That makes no sense. You can't pick a bottom, right? So right now in Tesla, you cannot be picking a bottom. You cannot be saying that now the bottom is done. All right. Right now, we are in a bearish trend. We have a divergent high bar. This means price will come lower within 3 candles. So within 3 days, we'll be at a lower price. And we'll probably get that lower price today. You can see the pre-market's opening up at 905. That's below yesterday's candle. So we know that that's coming, right? So you just don't want to trade counter trend. And it's really important for traders not to try and pick a bottom. Because if you try to pick a bottom, you can be horribly wrong. And remember, a lot of people trade to be right. They don't trade to be profitable. So, acknowledging when you don't have it right, you've got to also get that, that's a big part of the development of a trader, is recognizing that you're wrong. So, this is a tough one. I mean, if we look at Amazon, here we have Amazon. This would have been a very hard bottom to pick. Let me put the candles on. Yeah, this would have been a very, very hard bottom to pick. The only thing, and I'm not going to say that I traded, I didn't trade it, but the only thing that would have got you into a safe trade for this earnings was that white candle. Because the white candle indicates a divergent low, which means higher prices within 3 bars. And we got that on that pop on the open. So this is a very predictive candlestick for, algorithm that we have. So from here, I didn't trade it. I've got burnt with Amazon before at earnings. Because it was in a downward trend, because it was in this double red band, I can't trade bullishly in a red trend. So I have to wait for the green band. So here's the green band. We had a squeeze signal fire over here. So this squeeze signal here that got us in on the day of earnings has a 56% win rate with a profit factor of 1.8, took us from there to here. There's our exit. Now it's telling us to buy puts. So if we look at the win rate on that trade, so now I'm in a red forming band with a trigger to the downside that's got a 40% odd win rate. I'm not going to trade that. I'll only trade that once we break the trend line. So once we've broken this green line and we're down here and the signal's still valid and we have a squeeze firing to the short side, then you can trade it. So that's about having consistency with your rules, right? Let's look at Google, my favorite stock to trade. I told clients last week what we do is we got to wait for the gap to fill, right? So a lot of people got suckered into buying Google on that candle, right? Massive gap up, everyone's excited, stock splits coming, blah, 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 lots of money, etc., etc. A lot of people bought here. And what we did was we said, let's wait for it to fill the gap. There's the price. Look at that. It's given back everything that it gained on that pop on the open. Right now, I've got 2 signals telling me to go long, 57% win rate, 1.1. So these are not high amplitude moves, right? We've got some triggers. So once I get the price back above the VWAP, the volume weighted average price, I may be able to start putting in a 25-15 delta put spread somewhere in this region with a strike down here and start trading Google back to the upside. This is not going to go green until we cross out these 2 red bands. So we need to get above 28.31. We need to get above 28.44. Once we get there, these are going to start turning green. Then I can start going bullish.
So Google,
it's all about patience.
XLC component, correct?
Yeah, so Facebook is the bigger component of XLC compared to Google. So here's XLC. Here's the gray band, which is the equivalent of the red. Let's put on our bars. So you can see we have a divergent high bar printing right on VWAP, which indicates lower prices to come down. We also have a squeeze signal firing to the short side. So I think we're going to get lower prices on XLC. And that's largely going to be driven by Facebook and Google. Those are your 2 big ones. And then obviously you've got Disney and Twitter and all of them are included as well. But you can't go long or can't pick a bottom here. This is a hard stock to pick a bottom on. I love this stock. This is one I watch every day because when this repairs and when this starts to recover, this is going to move very quickly because it's been the weakest of the sectors for some time. The longer it remains the weaker sector, the better the reversal, right? So XLC, you don't really want to be in it. Here our band started to shift color, got us out. We had a strategy exit over there and a put signal over here. Looking at the success rates of the put signal, it's reasonable. This is a reasonable win rate. It's just the amplitude of the move is not very high, right? So for me, I wouldn't necessarily take the trade, but obviously the users of the tools have got the trade, so they can trade it if they want.
So what do you think? So I recently got an alert on XLF.
Let's have a look.
And
so let's look at financials.
I think this was I'm trying to remember. It was the 1321 RMA cross. No, that's a different alert.
Let's have a look. We'll build something.
It wasn't XLF. It was I'm everything.
On XLF or
it was KIE. I had a
KIE.
Yeah.
KRE.
KRE.
KRE. Okay, KRE. So regional banks. Okay.
Yeah.
So regional banks. So this is an interesting one. So here you've got a red band, but the formation of a green band starting. Let me just get these right. This needs to be 1.5. Let's put this one at, that's 2 on the chart, 1.5. And using the moving averages.
Mine was a 1321 RMA crossover.
1321 RMA.
Yeah, and it was like an 80%. There was like an 80% win
There we
rate.
go. 75. Yep, that's close enough. Probably using a 2 ATR.
Yeah, 2 ATR and like
there we go.
Position.
Yeah.
Like,
so you've got your entry over here on the green line, right? So you've got a number of tools that work here. So this is the VIX fix, right? So this is an entry. This is a strategy based on volatility reduction, right? So when we see the volatility drop down in sort of numerical value, there are triggers that can tell you to go long, right? So here we've got reduction in volatility happens just after that 1321 cross. So this is the 1321 cross. This is the volatility entry, right? So you've got 2 entries all in a cluster here. Let's have a look at the squeeze. So if we look at the squeeze got us out over here, but let's go and build something on the squeeze. So if we switch this up and we just open up all of the entries on the squeeze, right? So this is going to be for as many trades as you have on the squeeze. You can see it just, woof, it just explodes, right?
right.
But we're not going to trade all of those. This is about filtering out now the best setup that you can find. So the first thing that we always look at is, for me as a standard, is I look at the histogram and I look at the squeeze pro, right? So what this means is an entry on the second sort of candle or second histogram bar of a lower number, right? So my momentum to the downside is starting to slow down. So here I had this entry, I had the volatility entry on the candle next to it. Now I've got a squeeze entry right there. So within 4 days, I've had 3 signals. Okay, so this one's got a 60% win rate, 2.3 profit factor. So this one has a very nice amplitude of the move, and the average duration is 23 days. So this is a 3-week trade. So what you could do is you could take an entry based on all 3 of these. You've got your green band starting to form. You've got this double red, so you don't want to be sizing it too much. All right, you don't want to be sizing it too much. You've still got a downward sloping 813 trend line. So this to me is still a little bit bearish. Conservative traders would wait. They would go, no, I know that the signal is valid, but what I'm looking for is price target. So you would go in and say, okay, if it breaks the inside volatility band, so price needs to be above this line, you have greater confirmation that the price trend is shifting to the upside. So you would wait for that trigger. Once it crosses above that line, closes above this line, you would enter 1/3 of your trade. So what was your trade going to be? Oh, I was going to put down 4 contracts of this. Now I'm going to just do 1/3 of that. I'm going to do 1 trade, 1 contract. You put your stop loss at the bottom of 2 candles prior. So 2 candles prior would be here. My stop loss is there. And now I wait and I set the next trigger. And I go, if it crosses the trend line, which is this red line, when it closes above the trend line, I'm going to add 2 more contracts to my trade. So remember, the one that you put in here will be profitable by the time it gets up here. Now I'm going to average up. I'm going to add 2 contracts there. Now, once it goes there, let's say we started off with a long call, right? We did 1 contract. We wanted to make sure that we were outside of that average duration of 23 days. So we would have done maybe a 60-day 60 delta long call option on KRE, right? One contract. Now we've got 3 contracts over here, but now the trend is becoming more confirmed. Okay, so let's say we're in a situation where the squeeze signal continues to be valid, right? So in your properties function here on the tool, let me just change this down to 3 contracts. Okay, so I'm going to put in some extra orders, right? So what happens here is it prints an extra signal when the squeeze is still valid. So if it printed a few days before, I just want to see if it's still valid today, because now I'm still entering on the same signal. I'm just entering at a slightly higher price. So it reduces my win rate slightly because I've got a higher price that I've paid. Okay, but I can still enter the trade. Now, so we go from here to here. So we've got 1, 2, 3 contracts, long calls. Our trend is getting reconfirmed, but the volatility bands will start to become green. So they'll form this kind of color, right? What you do at that point is when I get that signal. So if I just switch now to this signal, you see this signal, this box has a 54% win rate. Okay. What I'm looking for is my green box. If my green box appears somewhere here and it says sell puts, and I'm here and I've got 2 green bands at the back, I'm not adding another call option. I'm going to finance it with a put credit spread. And I'm going to put my short strike somewhere down at the bottom of the volatility range because I've got these 2 layers acting as support. So if the price comes up here, it will more than likely, if it falls back, be held up here. And my put spread is somewhere down here. So I've spent 100 plus 200, and now I sell my put spread over here. Once I get up here, I sell my put spread. I'm going to get, let's say, a $200 credit. I've spent 300. I've got a $200 credit. But remember, these call options are now profitable. So when those call options are profitable and I now receive a credit, what am I doing to my overall cash in the trade? I'm spending less money. I become more efficient. I then start getting much higher returns just by using that strategy. Now, you could say, oh, I don't want to do a long call. I'm going to do a call debit spread. Fine. If you wanted to do a out of the money long call option, fine. If you wanted to do a butterfly, fine. It doesn't matter. The strategy at the end of the day is not that important. What's important is you trading the signals as they print. So you can continue to trade KRE as long as you continue to just, play it the right way. And what I try and say to people is a well-managed trade, when you've got signals and you've got triggers, is far easier to make money than having 10 trades on that are mismanaged. So I would much rather trade, XLE, for example. Here's XLE, and you can see how we've been trading it. Here's our trades. We've been trading it from here, right? And we did the same thing. We've just been adding and taking profits and then using the signals and triggers as they come in to add more trades. All right, now that we've broken up above this level of resistance, the next price point is 76. And we've been taking a load of profit here. Our duration of trades hasn't been very long. 14 days, 8 days, 4 days, 4 days, 12 days. You don't trade. I would much rather have lots of trades in a strong trend, in a double green sector over here that's got trend on its side, than have 10 trades in weak sectors having to manage all of them. I just don't, that's not efficient.
This is a much better way of playing an uptrending stock. It's basically milking that trend for all you can out of it. And
then there are not a lot of areas where you can milk today. A lot of the sectors are still double red, double red, red yellows. You don't want to be trading those because they're vulnerable to break the 8. And the problem now is that you've got so many sectors that are sitting around the 8, up above the 8 one day, below the 8 another day, dropping down to the 21. That stuff just gives you a headache, So,
is this Iron Condor territory?
Mate, you know what? The thing with Iron Condors and Iron Flies and all of that is, it's a certain type of temperament. I'm not good at them. I find they are hard to do, because if I put on an iron fly, let's say an iron fly is better for earnings, right? So you basically take a bet that something's not going to move far away from the mid strikes, right? The mid strikes are the same on an iron fly. On the Iron Condor, slightly easier. The problem is you don't get paid a lot the further away you go, right? So if you're sitting there going, well, I don't think we're going to get a 4 ATR move, or let's say you're not going to get a 3 ATR move, and you start putting in a whole lot of iron flies and iron condors, and then you get a 4 ATR flush like we had with Amazon back in June last year, you're going to pay. You can lose. You're never going to lose on both sides of an Iron Condor. You can only lose on one. But if you've structured the range too wide, you've got so much risk on that one trade, it will take off the gain that you made on the other, right? So I don't know. I think certain traders trade them well. Some traders trade them badly. I haven't got a good track record when it comes to Condors. I prefer one side of the trade only. So if I'm going to do a call credit spread, I'll do the call credit spread. I'll trade I very seldom use a Condor. I don't like them. It's just, for me, whenever I've done them, I tend to get burnt. And I just, avoid the stuff you're bad at, right? And I think it's important for traders to remember that. The other thing that I do is, the more exotic a structure or strategy sounds, the less effective it is. So, if someone's telling you to trade the triple pineapple, lizard ears, whatever it is, no, stick to the basics. There's a safer way to trade.
Sounds like some sort of cannabis strain or something.
Man, you know what? Unfortunately, in today's day, everyone's an expert, everyone's a guru, everyone, in social media is renting out someone else's jet and pretending it's theirs. I mean, I don't know, have you seen that Netflix show, that Tinder swindler dude that pretended he was the son of an Israeli diamond billionaire, and he was basically scamming these girls out of money, telling people that he was being attacked and he needed ransom money or whatever it was.
It's a con man, basically.
Yeah, the thing with trading is, unfortunately, everyone's an expert. Okay, everyone's an expert. Everyone's strategy is better than everyone else's, and you as a consumer are stuck in the middle having to make these decisions. The way that I try and teach my clients, everyone is different. There are many, many, many ways to make this work. My way is not the only way. It's just the way that works for me. I have some of my clients that are very different from me. They have different temperaments. They have different ways of looking at the market. Works for them, keep going. Keep going. There's nothing to say that it's wrong just because it's not the same as what I do. So, I think that the most important thing is the consistency of the analysis that needs to happen. So the tools that we build, or that I've built, try and take away the indecision. All right. So if you're looking at the screen, and you can see these things are printing in real time here, I'll pull up a chart and you can see it in real time. So here's SPY. Let's open up the 1 minute chart. We'll see how it works. So here you've got, SPY trading. This is what we do for intraday trading, right? So we've had lots of signals to go long on the squeeze tool back here. Let's open it up into a faster time frame, 30 seconds. So I would never trade the 30-second candle, right? So this just gives you an idea of signals and how they print and what have you. So when you're trading, there's some people who will interpret this differently from me. I will not trade bearishly in a green band. Some people will take the chance and they will do it. Our squeeze tool got us in here. It's closed on an ATR trailing stop here when it broke the vol band. So we've got an MA tool, our moving average cross signal, telling us to go long here. It's the same thing. It just prints on a faster time basis, right? So if you've got someone who wants to trade signals, they would trade these signals on a day chart. They only get one signal a day, end of the day. It stops you having to go in and look every minute of the day and drive yourself insane. So here was a long. We're in a double green band. You can take the trade. This one would be fine. Now we need to wait. Now you wait for the signal to improve. If this was a 5 minute chart, you would take the signal and wait 5 minutes and so on. So the tools have to help you analyze. That's the important thing. The tools must help you analyze. If they're not helping you make good decisions, then the tool's ineffective. But the decision as to what you trade and how you trade it, that's a completely different story. There are some people that would do on that crossover, they would do a long call option at the money for this week's expiration. There's some people who would do one for 14 days. Who's to say one is right and one is wrong? There's nothing wrong or right about that. It's just what works for you. So here you can see the volatility band turning into gray. That's a downward trend. So now you can't take a bullish signal that prints in this band. Okay, you can still be in this trade. So the next signal on this would be an exit bar, right? The gray column. So we would wait for the gray column. Now it's got to go past this blue. The momentum is still to the downside with a red candle. The next signal, if we just open this up, we got a purple bar that indicates lower prices. White bar indicates higher prices. So white bar, here's our higher price. Now, if this closes on a black bar, it would mean lower prices to come. So let's speed this up. So this is a 5-second chart. So this will print very, very fast. So slightly different looking chart from the other one. So here was our long entry. We had some squeeze tool entries there that got us out here on a break. White bar, higher prices. Black bar, lower prices. White bar, higher prices. So white bar, higher price. There's the higher price, green band. Now, blue bar, higher prices, trend shift. We have a crossover of that yellow line on the red line. So higher prices coming. Now we have a blue bar, which is a reversal of purple bar's reversal of the blue. This is pretending to be support. Let's see, now it's support. Let's see where this goes. So purple bar indicates lower price. Let's see where this one closes. This is a very fast chart, right? So
I say this is like watching like a horse race or something.
It's quite fun. It can be quite fun. It can be quite tedious actually, because you're sitting there and you're going, well, I'm in a long position. There's nothing worse than getting into a long position and immediately seeing the price come down. But you have to trust the signals, right? So here I'm in, let's say I'm in a long trade. Here we had higher price, lower price. So let's see, there's our lower price, higher price. This is printing really fast. I mean, it's a very, very fast signal. So when it switches from gray to green, that's telling you about, there we have a squeeze tool trigger for the long. So now we've got one entry here. Now we have another entry. So you could have added a second trade there. And you see it triggered and the price has gone up.
So you just have to figure out like what you're comfortable with. Like this is a little too fast.
Yeah, you would never, I don't know any one of my clients who trade 5-second charts.
Right. But I mean, just the intraday stuff, I prefer the daily.
This could have been a 5-minute chart, right? This could have been a 2-minute chart. It doesn't matter. The time frame and the signal prints on the time frame that you've got, right? So here on a 5-minute chart, we have a red candle with a black bar. Black bar, red candle means prices will come lower. So we need to see how this black bar resolves itself. We don't have a squeeze. We've got higher volatility. Our next candle could be a blue bar. If this crosses this red line, a blue bar indicates higher prices. So if this closes in 1 minute 47 seconds, potentially with the blue bar, because the price is rising, that could be an entry trigger. And then you would take the trade from here. Your exit point would be somewhere up here at 448. But you'd only get a signal once every 5 minutes, right? You're not going to get a signal until this bar closes. So, you could wait, go grab a coffee, watch a few minutes of a Netflix series, and then come back and check your trade. It's not, someone trading the 1 hour chart would wait for that hour to close, right? Here we can see there's 51 minutes to go before this trade or before the signal is going to print. So, no need to sit around and, overtrade, right? Here we had a lot of signals printing yesterday, 60% win rate with a 1.6. These are high amplitude moves in a green bar, in a green volatility band with a moving average cross. And we've got a signal to tell us to get ready. We've got a mid-level squeeze starting to compress. If this bar closes as a purple bar, we know that this will fire to the short side. We'll get a little arrow pointing down and we'll possibly go lower, and then move to the upside. So you have to watch this candle, what color it will print. We'll only know what color it will be in an hour. So as you trade, as clients start to trade, this is where you learn to build your plan. What are you going to do? Well, if you get a signal that says go long, I'm going to go long, and I'm going to trade that to the upside on that signal, and then you do it. So at least with these tools what your probability of winning actually looks like. That's important. You don't just want to trade something because you think it's going to work, because you read a trade book somewhere that said this works all the time. Now you have an idea of, okay, well, if it's only going to have a 60% win rate, would you oversize the trade or not?
But the back testing thing is really, really nice, because then it gives you some context for that signal. And
it's so important. I think the biggest weakness in any trade plan is expectation management. What do you expect to happen and what actually happens? And a lot of times with traders, they get stuck because you take accountability. You go, when a trade goes wrong, you go, shit, man, I'm the bad trader. And you start, your confidence gets whacked and everything. But you might have traded a perfect signal, just the incorrect way, right? You might have picked the wrong strategy. Okay. You might have also been subject to a black swan kind of thing where you don't control that. This sell-off that we got post the Fed back in December, January, beginning of December, January, how many traders sat back and went, holy crap, I'm a terrible trader because of that? I tell you what, 99% of the world lost money. You're not a bad trader because something happens in the market. You might have been a bad trader because you didn't exit. Maybe you oversized, maybe you got greedy. But a market event like that, you can't take accountability for it. You can't beat yourself up about it. You're just going to have to move on, right? If you had too many trades on, or if you were too aggressive with your sizing, that's an individual accountability thing. It's not the event that you take accountability for, it's the way you were trading. So those kind of things are really important, because your mind, the way you talk to yourself, will influence the way that you trade. And if you're constantly telling yourself, I'm a crappy trader because I lost money in January, when 99% of the world did, I can guarantee you're going to carry on losing money. You're going to trade to your self-speak. So if you say you're a crappy trader, you're going to be a crappy trader. You've got to get your head in the game. This is very much a head game.
Awesome. Yeah, definitely. Well, Chris, I appreciate it, and good luck today. Hope you make
Thank you, my friend.
Market, and I will talk to you soon next week.
Take it easy, man. We'll see you soon. Cheers then. Bye.